All right, so get ready because we're diving into something pretty interesting today.
Yeah.
It's the wealth effect. We're going to be looking at why it seems like so many people are feeling rich right now,
Yeah.
how that's impacting how everybody's spending their money, and then what it could mean for the economy.
Yeah.
And to make things a little bit more interesting, our main source for this deep dive is Anything But Ordinary.
That's right. We're looking at Twisty in the Spiz,
Okay.
which is it's a financial advice piece with a unique twist to it.
Yeah.
It's written by a business coach who calls himself
Okay.
Twisty.
Twisty.
Yeah.
Okay, got it.
So we're not talking, typical Wall Street analysis here.
Right.
This is coming from the perspective of someone who coaches chiropractors on business,
Exactly.
using bold language and some pretty quirky analogies.
Yeah, sometimes those unexpected sources can offer really surprising insights.
Yeah, I think you're right.
Sometimes stepping outside the traditional financial sphere can provide a fresh perspective.
For sure.
Okay, so before we get into Twisty's take, let's make sure we're all on the same page about what this wealth effect actually is.
Okay, so at its core, the wealth effect is the idea that when people's assets,
Okay.
things like stocks or real estate, increase in value, they tend to feel wealthier and therefore spend more.
Right.
It's a psychological phenomenon
Yeah.
connected to how we perceive our own wealth, not necessarily a direct reflection of disposable income.
Yeah, it's like when your stock portfolio's doing well.
Right.
And suddenly you feel like you can afford that extra vacation or, splurge on a fancy dinner.
Exactly.
Have you noticed yourself feeling this effect at all? Or maybe seen it in people around you?
I mean, it's a fascinating phenomenon to observe.
Yeah.
And it's particularly relevant right now, given the current economic landscape.
Okay.
According to Twisty's data, a record 43% of household net worth is currently in stocks,
Wow.
which totals nearly $70 trillion. Okay. That's a significant chunk of wealth tied up in the stock market.
At $70 trillion. It's a mind-boggling number.
It is.
And then on top of that, we have home equity.
Right,
Also
yeah.
booming, reaching a staggering $35 trillion.
Yeah.
So between stocks and real estate, we're talking about $104 trillion.
Wow.
2/3 of total household wealth
Yeah.
concentrated in these assets.
Precisely. And that concentration of wealth in assets that can fluctuate in value is one of the key factors
Yeah.
driving the wealth effect we're discussing today.
So we've got people feeling flush, and the numbers seem to support that feeling. But I have a hunch that Twisty doesn't think this is all sunshine and rainbows.
Yeah.
There's got to be a catch, right?
You're right on the money.
Okay.
Twisty cautions that spending like you're a baller because your assets are looking swole can be a risky game.
There's that signature Twisty flair.
Right.
So let's talk about those risks. What's the potential downside of this feeling rich behavior?
Well, the primary concern is that people might overspend relying on debt to maintain a lifestyle that their actual income doesn't support.
Okay.
They're essentially betting on the continued rise of those assets
Yeah.
to cover their spending habits.
It's like building a house of cards. Yeah?
Yeah.
It might look impressive for a while,
Right.
but it's incredibly vulnerable.
Yeah.
What happens when the market inevitably takes a downturn?
That's exactly the point.
Okay.
Twisty emphasizes pulling tomorrow's paycheck into today,
Right.
as they put it,
Yeah.
is a recipe for trouble when the inevitable market correction or economic downturn hits.
Mm-hmm.
And those who have overextended themselves financially could find themselves in a very precarious position.
So feeling rich doesn't necessarily equate to being financially secure.
Right.
That distinction seems pretty crucial.
Yeah.
And are there any indicators that this feeling rich party might be on the verge of a hangover?
There are some warning signs flashing.
Okay.
The data Twisty presents shows that savings rates are alarmingly low for many households.
Mm-hmm.
And credit card debt has ballooned to a record $1.1 trillion.
Wow.
That's a lot of people walking a financial tightrope.
Those are some serious red flags.
Uh,
Does this situation remind you of any previous economic bubbles? I'm thinking about the dot-com bust or even the 2008 financial crisis.
Sure.
Are we seeing a similar pattern here?
It's certainly worth considering those parallels.
Okay.
Both those events involved a disconnect between asset values and underlying economic fundamentals. Exuberance and speculation drove prices to unsustainable levels.
Right.
And when the bubble burst, the consequences were widespread and painful.
So the question becomes, are we in a similar bubble now?
Right.
And if so, how can people protect themselves?
That's where Twisty's unconventional wisdom comes in.
Okay.
They offer 3 twisted tips
Right.
for staying financially strong no matter how wild the market gets.
I'm all ears for these twisted tips.
Okay.
What does Twisty recommend for navigating this potentially volatile financial landscape?
So, welcome back to our deep dive into the world of the wealth effect.
Yeah.
We left off talking about, the potential risks of overspending and the big question of whether we're in an economic bubble or not.
Yeah, and thankfully, Twisty has some advice for us.
Right.
They gave us those twisted tips
Yeah.
to help us stay financially sound.
Exactly.
So let's dig into those, starting with the first one, buy quality.
All right, so buy quality.
It sounds pretty straightforward,
Yeah.
but I think as we were talking about earlier, understanding what constitutes quality in an investment requires a bit more explanation.
Yeah, you're absolutely right.
So how do we, cut through all the noise and pinpoint those companies that are actually built for the long haul?
Yeah.
What does quality actually look like in a company?
So it's about going beyond the surface and really examining the fundamentals of a business.
Okay.
You need to look at their financial statements, things like their income statement, balance sheet, and cash flow statement to assess their profitability, their debt levels, and, overall financial health.
So we need to pop the hood and look at the engine, so to speak.
Exactly.
But for someone who's not a financial expert, deciphering those financial statements can feel pretty daunting.
Yeah.
Where do you even begin? What are some of the key things that people should focus on?
Well, I think a good place to start is by looking at their profitability over time.
Okay.
Are they consistently generating profits?
Yeah.
And are those profits growing?
Mm-hmm.
That's a strong indicator of a healthy business.
Okay, makes sense.
Another crucial factor is their debt level.
Right.
A high debt-to-equity ratio can be a red flag indicating that the company's relying heavily on borrowed money, which can make them vulnerable to economic downturns.
Okay, so consistent profitability is a green light?
Yeah.
While heavy reliance on debt is a warning sign.
Right.
Makes sense. Are there any specific metrics or ratios that can help us assess these factors?
Absolutely. So when looking at profitability, one of the most important metrics is return on equity, or ROE.
Okay.
This tells us how effectively a company is using its shareholders' money to generate profits.
Got it.
A consistently high ROE is a sign of a well-managed, profitable company.
So ROE is essentially a measure of efficiency.
Yes.
How well a company is using its resources to make money.
Exactly.
That's helpful. What about debt? Are there any specific ratios that can, shed some light on a company's debt situation?
Yes, the debt-to-equity ratio, which we touched on earlier, is a good starting point.
Okay.
This ratio compares a company's total debt to its shareholder equity, giving you an idea of how much leverage the company is using.
Right.
A lower ratio generally indicates a more financially stable company.
All right, so we've got some tools to start evaluating a company's financial health.
Yeah.
But even if a company checks all those boxes, good profitability, manageable debt. Twisty's second tip reminds us to be wary of overpaying, right? Even a fantastic company can be a bad investment if we buy in at an inflated price.
You got it. That's where valuation comes into play.
Right.
We need to determine if the price we're paying for a stock aligns with the company's intrinsic value.
So you mentioned some valuation methods earlier.
Yeah.
Like discounted cash flow analysis.
Right.
Could you break that down a bit more for us? It sounds pretty complicated.
So discounted cash flow, or DCF, is a way to estimate a company's value based on its projected future cash flows.
Okay.
Essentially, you're trying to predict how much cash the company will generate in the coming years, and then discount those cash flows back to their present value using a discount rate that reflects the riskiness of the investment. This helps determine what the company is worth today based on its future earning potential.
So it's kind of like predicting the company's future earnings and then calculating what those earnings are worth in today's dollars.
Exactly.
Still sounds a little complex, but I'm starting to get the idea.
Yeah.
Are there any simpler ways to assess valuation?
Another approach is to look at valuation ratios, such as the price-to-earnings ratio, or PE ratio.
Right.
This compares the company's stock price to its earnings per share.
Right.
A high PE ratio might indicate that the stock is overvalued, while a low PE ratio could suggest that it's undervalued.
So it's all about context.
Yeah.
Comparing the company's ratios to its historical averages or to the averages of its industry peers can help us see if the stock price seems reasonable or out of line.
Exactly.
Okay, so we've got buy quality.
Yeah.
Don't overpay.
Right.
What about Twisty's third tip?
All right, so the third tip is to play the long game.
Okay.
This is all about patience and recognizing that building wealth takes time.
Right.
It's easy to get caught up in those short-term fluctuations of the market.
Yeah, for sure.
But Twisty reminds us that quality investments tend to pay off over the long haul.
They use the example of Japan's stock market,
Right.
which experienced a prolonged period of stagnation.
Yeah.
That must have been tough for investors who were hoping for quick returns.
It was undoubtedly challenging, but the point is that even in that scenario, investors who focused on solid companies and rode out the downturn ultimately saw positive returns.
Right.
It highlights the importance of having a long-term investment horizon and not panicking when the market inevitably experiences dips and corrections.
It's a reminder that investing is more like a marathon than a sprint.
Exactly.
Consistency and discipline are key even when things get bumpy.
Absolutely. Having a well-defined investment plan and sticking to it even when emotions are running high can make all the difference.
Yeah.
It's easy to get swept up in the fear and greed that can drive market swings, but having a clear strategy helps you stay grounded and make rational decisions.
So buy quality, don't play the long game.
Right.
Those are some pretty solid twisted tips for navigating this unpredictable world of investing.
I think so.
But I'm curious to hear your thoughts. You have any additional advice for listeners who are trying to make sense of all this and build a solid financial foundation?
Absolutely.
Welcome back to the final part of our deep dive into the wealth effect. We've explored the psychology behind it, the potential risks, and even gotten some unconventional advice from Twisty on how to navigate this tricky financial terrain.
Yeah, we've covered a lot of ground.
You have.
From analyzing financial statements to understanding valuation and the importance of long-term thinking. But now let's shift gears a little bit and talk about, what listeners can actually do with all of this information.
Yeah, that's the key question, isn't it? It's one thing to, understand the concepts, but quite another to actually put them into action in our own lives.
Yeah.
So let's get practical.
Right.
What are some tangible steps people can take to, improve their financial well-being, regardless of whether they're feeling rich, actually rich, or somewhere in between?
Well, I think the first step is to take an honest look at your current financial situation.
Okay.
That means tracking your income and expenses, listing out your assets and debts, really getting a clear picture of where you stand financially.
So you're talking about creating a budget.
Yes, but it's more than just a budget. It's about understanding your financial flows.
Right.
Where your money is coming from and where it's going. This awareness is the foundation for making informed financial decisions.
It's about, gaining clarity and taking control of your finances.
Precisely. Once you have that clear picture, you can start setting financial goals.
Okay.
Both for the short term and the long term. These could include things like paying off debt, building an emergency fund, saving for retirement, or even investing for future goals like buying a home or starting a business.
It's like having a financial roadmap. You need to know where you are now and where you want to go before you can figure out how to get there.
Exactly. And once you have those goals in place, you can start developing a plan to achieve them. This might involve creating a detailed budget, automating your savings, exploring different investment options, or seeking guidance from a financial advisor.
I think that last point is especially important for people who might feel overwhelmed by all of this. There are so many financial products and strategies out there.
Right.
It can be really tough to know where to start or who to trust.
Absolutely. A qualified financial advisor can be invaluable in helping you create a personalized plan, navigate those complex financial products, and hold you accountable for staying on track with your goals. It's like having a financial coach in your corner.
So it's not just about DIYing your finances. Sometimes getting expert advice can make a world of difference.
Exactly. But even with professional guidance, it's still important to educate yourself and stay informed about your own financial decisions.
Right.
There are tons of excellent resources available, from books and websites to podcasts like this one, that can help you expand your financial literacy.
Twisty's source material even mentions some classic personal finance books.
Oh, yeah.
Have you read any of those?
I have, and I think they offer some really valuable insights. But it's important to remember that personal finance is, personal.
Yeah.
What works for one person might not work for another. The key is to find an approach that aligns with your individual goals, risk tolerance, and financial situation.
It's about, finding what resonates with you. and what fits your specific circumstances.
Exactly. And it's crucial to emphasize the importance of continuous learning.
Yeah.
The world of finance is constantly evolving, so staying informed and adapting your strategies as needed is key. Whether it's reading books, taking courses, or simply staying up to date on financial news, making an ongoing effort to educate yourself can make a big difference in your long-term financial success.
It's a journey, not a destination.
Precisely. And I think that's what makes it so engaging. It's a continuous process of discovery and growth.
Well said. So as we wrap up this deep dive, what's the one key takeaway you want listeners to walk away with?
I think the most important message is that feeling rich and being financially secure are not always the same thing.
Yeah.
It's great to feel optimistic about your financial future, but it's crucial to back that feeling up with sound financial habits and a solid plan.
It's about aligning your feelings with your actions, taking control of your finances, and making informed decisions that will set you up for long-term success.
Exactly. And remember, building wealth is a marathon, not a sprint. It takes time, patience, and discipline.
Yeah.
But with the right mindset and strategies in place, anyone can achieve their financial goals.
That's an inspiring message to end on. So for all our deep divers out there, whether you're just starting your financial journey or you're already well on your way, remember that knowledge is power. Keep learning, keep growing, and keep striving for financial well-being. Until next time, keep exploring, keep questioning, and keep diving deep.